91% of individual retail traders operating in the derivatives segment incur net losses. Every year, over 100,000 crore rupees are transferred from these retail accounts directly to institutional liquidity providers. Standard analysis often attributes this mass failure to a lack of trading psychology or emotional discipline. However, the data reveals that portfolio blowout is a mathematical certainty hard-coded into the pursuit of fixed daily yields. To understand why, we must conduct a quantitative autopsy of the 1% daily quota and expose the physics of institutional exploitation. Without mapping the math of derivative decay, the retail trader acts as a systemic donor to institutional algorithms. Attempting to extract a linear 1% daily yield is a violation of the laws of financial physics. Short-dated options force an operator into a three-front war: direction, speed, and time. Theta represents the constant linear erosion of time decay, leaking value from the portfolio every minute the asset remains stagnant. This grid visualizes the Taylor series expansion for a portfolio's value. The steeply curving slope represents $gamma, the exponential threat derived from the quadratic term of the portfolio's price sensitivity. The narrow plateau is the gamma-theta break-even range. As expiration approaches, this safe zone collapses, leaving no room for error. The pressure of a daily quota often forces operators to enter suboptimal setups, pushing them off this plateau and down the exponential drop-off. Once the price breaks this threshold, the demand for rebalancing becomes inelastic. The trader is forced to buy or sell at any price to prevent a total collapse, triggering a self-cannibalizing gamma squeeze. Forcing a calendar-based extraction target on a volatile asset guarantees nonlinear, irreversible decay. On the other side of these trades, institutional market makers utilize agentic AI hardware to manage vast order flows. These institutions operate under a strict delta rebalancing mandate, seeking liquidity rather than speculating on price direction. Institutional algorithms map the market using structural anchors, like this 200 simple moving average. Note the thousands of data markers clustered just beneath it. Because retail traders predictably park their stop-loss orders in these clusters, the 200 SMA becomes a massive liquidity magnet. Algorithms engineer a liquidity sweep by driving price through the SMA. This triggers and absorbs the retail stops to fulfill the institution's rebalancing needs. This rapid reversal leaves behind a fair value gap. It sidelines the traders whose stops were just triggered and traps those who entered new short positions, believing the pierce was a genuine breakdown. Institutions legally harvest capital by engineering traps at the exact boundaries where quota-driven traders hide their risk. Portfolio survivability is governed by the Balsara-Vince risk of ruin equation. This data table illustrates the cost of aggression. Shifting risk from 1% to 5% to chase a daily quota causes a 2,700 times exponential spike in the probability of a total blowout. Sequence of returns risk ensures that early losses hollow out the capital base. If the principal is depleted too early, the gains required for recovery become mathematically impossible. This creates Satyam profits, the illusion of success where highly leveraged gains mask a fragile, rotting balance sheet. This financial fragility triggers vicarious autonomic arousal. The daily quota stress releases cortisol, actively suppressing the prefrontal cortex, the region responsible for logical rule adherence. This allowed the amygdala to take control, shifting the trader from clinical analysis into a fear-based survival mode. The 1% quota is a biological trigger designed to ensure the operator panics and abandons their system. Survival requires an institutional firewall to decouple execution from these biological threat responses. The 8i momentum system creates a sterile execution field. Entry requires the 12 and 24 exponential moving averages to slope upward with an expanding MACD histogram. No trade executes unless these signals are supported by the 100 and 200 simple moving averages structural foundation. Managing the probability of ruin requires a shift to the 8th Kelly protocol. This model applies a Kullback-Leibler divergence penalty, a numerical buffer for the gap between a strategy's backtest and the actual market regime. It assumes the trader's edge is slightly less certain than historical data suggests. This penalty aggressively reduces the position size, enforcing a risk cap of approximately 1.9%. This conservative buffer ensures the portfolio survives the losing streaks that typically trigger an amygdala hijack. By dynamically capping risk, the operator maintains the biological calm necessary for high-stakes execution. The concept of a guaranteed 1% daily yield is a retail delusion feeding institutional liquidity needs. Human willpower cannot compete with the reliability of mechanical, algorithmic execution. Measured, the only law that separates the 0.01% tier from the majority who fail is that process kills emotion. Scaling is achieved by hiding behind structural anchors and optimizing for long-term growth rather than daily targets. The market only yields to those who align their execution with the unvarnished mathematical reality of the system.